Welcome back to another video, guys. So today I wanted to speak really quickly and really simply about what a hedge fund is. I think it's really important that everyone knows what a hedge fund is because it affects your investments. These are funds that move markets quite often, and it's just something that, very recently it's been on the news quite a bit, so I thought it might be interesting just to speak a little bit about it. So a hedge fund is essentially a pool of money where investors put money into the pool, so their limited partners put money into the pool, and a fund manager, a general partner, manages that money for them. The difference between a hedge fund and, say, a traditional mutual fund, there's a range of differences, tax differences, legal differences, but very simply, the main difference is that a hedge fund can employ a larger range of investment strategies. So while a mutual fund may just go long on a stock, so buy and then wait for the price to rise, a hedge fund could either bet for or bet against the stock. It could go long or it could go short. When understanding hedge funds, you really need to break down the word first. So you have hedge and you have fund. Hedge is to protect. A hedge fund aims to protect investors' money from potential market crashes, for example, by hedging their positions. For example, a hedge fund might go long on a stock, but in the event that the stock price falls and the hedge fund's idea was wrong, they might have also hedged their position using a derivative. Now, derivatives are a whole other video. I'm going to save that for another video, but for now, think of it as an instrument that hedge funds can use to protect against their downside losses. So if the stock crashes, if the hedge fund had bought a derivative like, say, a put option, which allows you to short that stock simultaneously as you bought it, but you also bought some put options, then your losses will be minimized because you've also taken a short position. So broadly speaking, you have four types of hedge funds. You have directional hedge funds, you have global macro hedge funds, you have event-driven hedge funds, and you have relative value hedge funds. Directional hedge funds, very simply, are funds that invest in the direction of the market. So if they think that a stock will rise or a market will rise, they'll go long on it. If they think it'll fall, they'll go short on it. Global macro hedge funds invest in macroeconomic trends, so monetary policy, fiscal policy, usually betting on currencies, sovereign bonds and things like that. So using the macroeconomic environment as a lens to invest. Event-driven hedge funds will invest based on the likelihood at which they believe a certain event will happen. So if they think an IPO is coming, a scandal in the company, political turmoil in a country, they will invest based on their predicted likelihood of a certain event happening. And finally, a relative value hedge fund is a fund that invests in, say, companies, or it could be fixed income or anything, but for now, in companies which they think are priced incorrectly relative to their value, relative value. So for example, relative to a company's assets, its book value, where is the price? Is the price too high? Go short on the stock. Is the price too low? Go long on the stock. It's kind of that. It's more complex, but that's the general idea of it. Now, unfortunately, we as individuals cannot usually go and invest in a hedge fund. And this is not a conspiracy, this is usually for safety reasons. The positions that hedge funds take are very risky and there's a lot of leverage involved. Leverage is essentially debt, and hedge funds use a lot of debt to invest, and this either amplifies returns or amplifies losses. And that's why when you invest in a hedge fund, you can either expect to gain a lot of money, outperform the market. So in the case of, say, a lot of hedge funds, you actually lose a lot of money. And it's for this reason that there are restrictions on who can actually go ahead and invest in a hedge fund. The minimum deposit in a hedge fund is usually 1 to 5 million, and once you put your money in, it's locked up for a few years. There's all these conditions. So for that reason, it's usually ultra high net worth individuals or institutions like pension funds and insurance companies that go ahead and invest in hedge funds. Well, that's all for today, guys. I hope you enjoyed this video and you learned something. Next time you see the word hedge funds on the news, you would have a much clearer idea of what it is and what they do. I got a lot of positive feedback on the previous video on the Sri Lankan debt crisis, and this really sort of helps me stay motivated and really encourages me. So if you can hit the like and subscribe buttons below, it would really go a long way. It's still a small channel, and that one subscriber really goes a long way. Well, that's all for today, guys. I'll see you in the next video.